Okay, let's dive in. We are constantly, bombarded with economic numbers.
All the time. Headlines everywhere.
Exactly. The economy grew by X percent, or
Yeah.
GDP is projected to hit Y trillion. These figures, they really shape headlines, political debates, even just how we feel about how the country's doing.
They absolutely do. But, you know, if you peel back the curtain a bit,
Hmm.
what do these numbers actually mean?
That's the question, isn't it? How do you even begin to measure something so immense, so diverse? I mean, every single good and service produced across an entire nation in, say, a year. It feels almost impossible when you think about it.
Well, it's a question that's kept economists busy for, well, centuries, really. And it's definitely far more complex than just, adding up sales receipts.
Right.
You're trying to capture the value generated by millions of people, millions of businesses. From the farmer growing crops
To the software engineer writing code.
yeah, government building roads, yeah, and the big multinational corporation assembling electronics, it needs some pretty sophisticated definitions and careful methodology.
And that's precisely our mission today in the deep dive.
Hmm.
We've got quite a stack of sources here that really dig into these fundamental concepts,
Yeah.
behind measuring economic output.
And we're using the Indian economy as a kind of case study, right? It's complex,
Yeah.
dynamic.
I mean,
A good example.
exactly. So we're going to unpack the core ideas. Things like what is output, what gets counted, what doesn't,
Mm.
how does production link to income.
And, navigating those global flows, accounting for wear and tear,
Yeah, sure.
depreciation, figuring out how to handle prices, which is a big one.
Oh, yeah. And even getting into the real nitty-gritty of how countries, like India recently, have actually revamped their whole measurement system.
And what you'll find, I think, is that the devil really is in the details, these seemingly technical choices.
Yeah.
Like how you define a final good, or how you account for depreciation, or even just which data sources you decide to use. They can significantly change the final numbers.
And that changes our perception, right?
Right.
Of how the economy is actually performing.
Absolutely. Those recent changes in India's methodology, for instance, they sparked a lot of discussion, precisely because they changed the picture,
Yeah.
particularly for some key sectors like manufacturing.
Right. So if you've ever looked at a GDP headline and just thought, okay, but how did they get that number? Well, this deep dive is definitely for you. Let's strip it all down, build our understanding piece by piece.
Sounds good. So where should we start? Maybe the most fundamental concept. What is economic output, at its core?
Yeah, let's do that. So when we talk about the output of an economy,
Yeah.
I mean, at the very basic level, we're talking about the total value of all this stuff.
Yeah.
So,
Yeah. Goods and services.
goods and services, exactly.
Hmm.
Everything that was produced over a specific period of time. Think of it, well, everything that gets made or done that people are willing to pay money for.
Precisely. It's the aggregate monetary value. That's a key phrase of all goods and services. Produced within a defined time frame. Could be a quarter, could be half a year, or a full year, calendar or financial.
And you said monetary value is key. Why is that so important?
Well, because it's not just about counting things like the physical quantity. It's about the value that's assigned to that production when it gets exchanged, usually in the market. So it generally means only goods and services that are actually bought and sold, or maybe have a clear market equivalent value, get included.
Okay, that makes sense. The sources use a really simple but I think effective example for this.
Oh.
A fisherman.
Ah, yes, the fisherman.
Right, so if this fisherman catches fish and takes them home to feed the family,
Yeah.
that bit isn't counted in the economic output figures.
Even though it's consumption, yeah. But it didn't enter the market economy.
Exactly. But any fish the fisherman sells down at the market, the monetary value of that sale, that is counted. It's all about activities that generate market transactions, basically.
Okay, so we're adding up market values. But as soon as you start trying to add up everything produced across a whole economy, you hit a pretty major roadblock almost immediately. A challenge that, if you don't handle it carefully, it can completely distort your numbers.
Okay. You must be talking about the double counting problem.
That's the one.
This is absolutely critical to grasp, isn't it?
It really is, because to avoid this double counting, you absolutely have to differentiate between what we call intermediate goods and final goods.
Okay. Intermediate versus final, what's the difference?
So intermediate goods are things that get used up in the process of making other goods. Think about steel. It's an input for cars. Flour is an input for bread. Cotton for shirts. They get consumed, essentially, within the production chain.
Right, they're ingredients, basically.
Kind of, yeah. Whereas final goods, they're at the end of that chain. They're the goods and services that are purchased for, well, final use or consumption, like a car bought by a family.
Or the loaf of bread you buy from the bakery.
Exactly. Or a finished building, or even a service like a haircut. They aren't going to be used as inputs into yet another production process down the line.
And the double counting trap becomes pretty obvious then, right?
Yeah.
If you counted the value of the steel when the steel mill produced it, and then you counted the full value of the finished car, which already includes the value of that steel.
You've counted the steel twice. Simple as that. You'd be artificially inflating the total output figure.
Or like the bread example, counting the wheat value, then the flour value, then the final bread value. You'd be counting the same underlying value multiple times as it moves through the stages.
So the fundamental rule, the bedrock principle to prevent this, is that output should only include the value of final goods and services. The value of all those intermediate goods is implicitly captured within the value of the final goods they helped create.
Okay, so you count the value of the final loaf of bread.
And that value already incorporates the value of the flour and the wheat and everything else that went into it.
Got it. And this principle also helps explain why selling something secondhand doesn't count towards current output.
Right, exactly. If you sell your used car, for instance, that car was already counted in the economic output figures way back in the year it was first manufactured and sold.
Its resale now is just...
What, a transfer of ownership?
Yeah, just shifting existing assets around. It's not a new act of production. It's not adding fresh value to the economy in that period.
Okay. So let's refine our definition then. The output of an economy is the monetary value
Of the final goods and services.
produced within a specific time period, and, crucially, designed to exclude intermediate goods to avoid that double counting.
That's it. That's the bedrock concept. Everything else in national income accounting builds on that foundation.
Okay, that makes a lot of sense. So we know what kind of stuff gets counted, the final stuff. Now, maybe let's think about who is actually doing the producing. Who are the players generating all this output? Right. Well, economic output, it's generated by a really wide array of entities within a country. I mean, you've got individuals, right? People running small shops, providing freelance services.
Sure. Like consultants, artists, small store owners.
Yeah. Then you have private companies, both large and small.
Huh.
The sources specifically mention some big Indian examples like the Tata Group, the Birla Group, Reliance Industries, huge conglomerates involved in all sorts of economic activities.
And then there's the government sector, too.
Definitely. The government produces goods and services through what are called public sector undertakings, or PSUs. Examples given are ONGC, the Oil and Gas Corporation, or SAIL, the Steel Authority of India.
And importantly, it's not just domestic players, is it? Foreign companies operating within the country count, too.
Absolutely. Companies like Nokia, Sony, or Samsung, if they have factories or operations within India, for example, their production in India contributes to India's output. It doesn't matter where the company headquarters are. It's about where the economic activity making physical goods, providing services, actually happens. All of that adds to the total output generated inside that country.
Okay. And how do all these producers, individuals, companies, government, foreign firms, how do they actually make things? What are the essential ingredients they need?
Well, that brings us to the classic concept of the factors of production.
Land, labor, capital.
And entrepreneurship, exactly. To produce basically any good or service, you need a combination of these fundamental resources. You need a physical space or infrastructure or natural resources traditionally called land.
Right. The place where production happens.
Then you need financial resources, money to invest in machinery, buy raw materials, maybe fund technology development, that's capital.
Okay.
You need people, obviously, to perform the tasks, whether it's manual work or intellectual work, that's labor.
Makes sense.
And critically, you need someone or some entity to organize it all, to manage things, innovate, and importantly, take the financial risk of bringing land, labor, and capital together to produce something. That's the entrepreneur, or entrepreneurship. These four are seen as the fundamental building blocks.
Land, labor, capital, entrepreneurship. Okay, and this is where it gets really interesting, I think, because there's this relationship, almost like a circle, between the output produced, the cost of producing it, and the income that gets generated.
Exactly. It's like looking at the same economic event from three different perspectives. They should all balance out.
How does that work?
Well, think about it from the producer's point of view first. the entrepreneur, let's say, they incur costs for using these factors of production.
Okay.
They have to pay rent for the land or the factory space they use. That's a cost. They pay interest on the money they borrowed the capital, or they expect a return on the capital they invested themselves. Another cost.
Right. Wages, too.
Absolutely. They pay wages and salaries to their workers, the labor. That's a big cost. And then if they're successful, what's left over after covering all these other costs, that's profit.
And profit is the return to the entrepreneur, right?
Yes.
For taking the risk, organizing everything.
Precisely. So rent, interest, wages, profit, these are the costs from the producer side.
And here's the cool part. The insight, what's a cost for the producer, is actually income for whoever owns those factors of production.
Exactly. The rent the producer pays, that's income for the landlord who owns the property.
The interest paid on capital.
That's income for the bank or the investor who provided the capital.
The wages and salaries.
Income earned by the workers, the laborer.
The profit.
That's the income for the entrepreneur.
So cost on one side equals income on the other.
It does. And the sources give us a really clear, simple numerical example to kind of lock this in. Imagine, just hypothetically, a small producer's costs over some period, let's say. Rent for land is $10,000.
Okay.
Wages and salaries for labor total $1,000.
Okay.
Interest paid on capital is $750.
Right.
And the profit for the entrepreneur after all that is $500.
Okay, so the total cost for this entrepreneur to produce whatever they're producing is $10,000 plus $1,000 plus $750 plus $500. Dirico, carry the one.
Yeah.
That's $12,250, right?
Exactly. The total cost incurred is $12,250. Now, what's the value of the output produced by this entrepreneur in this period?
Well, based on what we just said, it must be the same, $12,250.
Precisely. The value of the output is $12,250. And now let's look at the total income generated for everyone who provided those factors. The landlord got $10,000 in rent.
Right.
The workers got all $1,000 in wages.
Yep.
The capital provider got $750 in interest. And the entrepreneur got $500 in profit.
Add those up. $10,000 plus $1,000 plus $750 plus $500. It's $12,250 again.
Wow, it works out perfectly.
It does. The total cost of production equals the total value of the output, which also equals the total income distributed to everyone involved. It's like a fundamental economic identity.
It absolutely is. And this is why in national accounting, you'll hear output, cost, and income used almost interchangeably sometimes. They're seen as different ways of measuring the exact same underlying economic activity. The total value of goods and services produced, output approach.
Should equal the total spending on those goods and services.
Oh.
That's the expenditure approach, which we're not really covering today, but it's another angle.
Right. And both should also equal the total income earned by the factors of production, the income approach. This is why measures of output are often called product, or sometimes just income. They're fundamentally linked.
Okay, this is making a lot more sense. So we understand output and we see how it generates income within sort of a conceptual boundary.
Yeah.
But real economies have physical borders, right? National borders.
Exactly. And this is where the distinction between domestic output and national output becomes really important.
Okay, domestic versus national.
So remember, we first defined output as production happening within a certain area. If we define that area specifically as the geographic boundary of a country, we get what's called domestic output.
Right. So everything produced inside the country's borders.
Yes. It's the monetary value of all final goods and services produced within the physical territory of a country, regardless of who produced it. So in the Indian context, it includes everything produced physically inside India's borders. Doesn't matter if it's by an Indian citizen, an Indian-owned company, private or public sector, or a factory owned by a foreign company like Samsung operating, say, in Chennai. It's purely about where the production took place.
Okay, that's domestic product.
Yeah.
But what about, say, Indian citizens working abroad, like in the Gulf or the U.S. or wherever, and sending money back home? Or Indian companies that have operations overseas and earn profits there? That income wasn't generated inside India's borders, but it flows back to Indian residents or companies.
Exactly. That's where national product comes in. If you want to understand the total income that accrues to the residents or nationals of a country, regardless of where in the world that income was actually earned, you need this concept.
So how do you get from domestic to national?
You start with the domestic product, all the value created inside the borders. Then you need to make an adjustment for these income flows across borders. You add the income earned by your country's citizens and companies from their activities abroad.
Okay, add the income flowing in from your nationals overseas.
Yes, but You must also subtract the income that was earned by foreign nationals and foreign companies who are residing and operating within your country's borders, because that income eventually flows out of your country back to their home nations.
Okay. So it's a net calculation. The difference between what your citizens earn abroad and what foreigners earn in your country.
Precisely. And that difference has a name: net factor income from abroad, often abbreviated as NFIAD.
NFIAD, got it. Net factor income from abroad.
So the formula becomes domestic product plus or minus NFIAD equals national product.
Plus minus. So NFIAD can be negative.
Oh, absolutely. If the income flowing out to foreigners operating in your country is greater than the income flowing in from your citizens abroad, then NFIAD is negative. In that case, your national product will actually be lower than your domestic product.
And if more flows in than out, NFIAD is positive and national product is higher than domestic.
Exactly. And the sources really emphasize why this distinction became so crucial, particularly in policy discussions.
Yeah.
They point out scenarios like, imagine a country takes on a lot of foreign debt.
Okay.
The interest payments on that debt have to be made, right? Those payments flow out of the country to the foreign lenders. That reduces NFIAD, and therefore it reduces the country's national product.
Right. Less income ultimately stays with the nation's residents.
Or, another example, if domestic companies or assets are increasingly bought up and owned by foreigners, the profits generated by those companies or assets, or the rent from those assets, that income flows out to the foreign owners. Again, that reduces NFIA, reduces national product.
But wait, in both those cases, the actual production happening inside the country might not have changed at all, right? The factory is still producing goods, the workers are still working.
That's the key point. These are financial transactions, changes in ownership structures. They impact the national product because they affect who ultimately receives the income. But the core production activity happening within the country's physical borders, the domestic product, or GDP, might remain largely unaffected. That factory producing goods inside India still contributes fully to India's GDP, even if its profits are flowing out to an owner overseas, which would simultaneously be reducing India's GNP, gross national product.
Wow. That is a really powerful distinction. And the sources basically say this is a major reason why GDP, the domestic product measure, has become the standard metric globally for tracking economic growth, overtaking the national measures like GNP or NNP.
That's exactly what they suggest.
Wow.
GDP is seen as a more direct indicator of the actual production engine running within the country's borders. It's less volatile, less affected by those international financial flows or shifts in foreign ownership that might not reflect the core health of the domestic economy itself. It focuses purely on the value being added by factors of production physically located within the country.
Okay, so GDP is king because it measures the activity here on the ground.
Yeah.
Makes sense. Now, moving on, there's another really vital adjustment we need to talk about. Production isn't just about making, bread and cars for consumers. It also involves using and building the things that make those things. Machines, factories, infrastructure, capital goods.
Right, capital goods. And the crucial point here is that these capital assets don't last forever.
They wear out, they depreciate. Or they just become obsolete because of new technology.
Precisely. Depreciation.
Yeah.
So the total output measured in GDP includes the creation of new capital goods, new machines being built, new factories constructed. But, and this is important, a pretty significant chunk of this new capital production is often just replacing the old capital that got consumed or worn out during the production process itself.
Right. So if you build 10 new machines, but 8 old machines wore out and needed replacing, you've only really added 2 machines to your total capacity.
Exactly. If you don't account for this wear and tear, this depreciation, you're kind of overstating the net addition to the economy's productive capacity. You're not showing how much capital was used up just to maintain the current level.
The sources use a car example again here, Rose.
Yeah.
If a car is used as a capital asset by a business, maybe it costs 300,000 euro, and it's expected to last 10 years in service.
Then you could say a portion of its value, roughly 30,000 per year, is effectively used up as it operates. That's its annual depreciation or consumption of fixed capital. If you don't subtract that 30,000 from the value generated using that car each year, you're not getting a true picture of the net value added after accounting for the capital consumed in the process.
Okay, so this leads to the gross versus net distinction in these measures.
It does. When an output calculation ignores this consumption of fixed capital, when it doesn't subtract depreciation, it's referred to as a gross concept.
Like gross domestic product, GDP, and gross national product, GNP.
Exactly. Those are gross measures. They include the total value of new capital goods produced without netting out the value of the old capital that was used up or depreciated during the period.
And if you do account for depreciation, if you subtract it.
Then you get the corresponding net concept. So net national product, or NNP, is just GNP minus depreciation. And net domestic product, or NDP, is GDP minus depreciation.
Okay, so that gives us our four core aggregates: GNP, gross national; GDP, gross domestic; NNP, net national; and NDP, net domestic. These are the big ones we often hear about when discussing the size and growth of an economy.
They're the fundamental measures, yes. And historically, net national product, NNP, was sometimes seen as maybe the theoretically best measure. It was often even national income.
Why NNP specifically?
Well, the argument went like this. It covers income accruing to all the nation's nationals. That's the national part. And because it's net, it accounts for the capital consumed in production. So theoretically, it represented the true sustainable income or the net addition to wealth for the nation after you've set aside enough to maintain your existing capital stock.
Kind of like the nation's take-home pay after accounting for wear and tear on its assets?
That's a decent analogy, yeah. But, as we already touched upon, the practical focus shifted pretty decisively, and GDP, gross domestic product, became the almost universally accepted standard for measuring economic growth around the world.
Right. Despite NNP maybe being theoretically purer, why the shift back to a gross measure and a domestic one?
Well, the sources reiterate the points we discussed regarding domestic versus national. GNP and NNP are significantly affected by that net factor income from abroad, NFID. Things like rising foreign debt payments or increasing foreign ownership of domestic assets. They cause larger outflows of income. That reduces NFID, which pulls down GNP and NNP.
Even if domestic production hasn't changed?
Exactly. It might not reflect a change in the core production happening inside the country. So GDP, being the measure of production within the borders, is seen as a more stable, more relevant indicator of the domestic economic engine's actual performance in that period. It tells you how much value is being added by the factors physically located within the country before worrying about who owns them or where the income ultimately flows.
So GDP won the popularity contest partly because it's just a clearer, less potentially distorted picture of the economic activity happening on a country's own soil, less sensitive to those global financial flows that might not directly reflect domestic production levels.
That's a big part of the reason, yes. It focuses on the engine itself. Now, another crucial layer. Let's talk about how we actually assign the monetary value to all this output we've been discussing. We keep saying monetary value, but there are actually two main ways this value can be viewed or measured, leading to different price points for the very same goods and services.
Okay, and these are factor cost versus market price.
That's right. Think of factor cost first. You can view the value of output based on the cost of the inputs, the factors used to produce it. As we discussed earlier with the cost-income identity, this essentially equals the total income distributed to the factors of production, the sum of wages, interest, rent, and profit.
So it's the value from the perspective of the producer's costs or from the perspective of the income earned by the factors.
Exactly. It reflects the value added at the point of production before certain government interventions hit the price tag.
Okay, and market price then is just what it sounds like.
Pretty much. It's simply the price that the final consumer actually pays for the good or service when they buy it in the market.
So what creates the difference between the factor cost and the market price?
The government. Essentially, governments step in and do two main things that affect the final price. First, they levy indirect taxes on the production or sale of goods and services. Think of things like excise duties, sales taxes, value-added taxes like GST in India now, service taxes. These add to the price.
Okay, taxes increase the price.
But governments also often provide subsidies for certain goods or services, like subsidies on food or fertilizer or fuel. These subsidies reduce the final price paid by the consumer.
Right, so taxes push the price up from the factor cost, subsidies pull it down.
Precisely. These taxes are generally added after the initial production cost, but before the good reaches the final market, and subsidies effectively reduce the price at that point. So the basic relationship is factor cost plus those indirect taxes minus the subsidies equals the market price.
Okay, factor cost plus indirect taxes, subsidies, market price. And the sources simplify this sometimes, right? Using net indirect taxes.
Yeah, you can just lump the taxes and subsidies together. Net indirect taxes are simply indirect taxes minus subsidies, so the formula becomes factor cost plus net indirect taxes equals market price.
Okay, now, here's a key question. When you're trying to measure the growth of economic activity over time, Which price point should you ideally use? Factor cost or market price? The sources seem to argue for factor cost, at least historically in the Indian context.
They did, and the logic is quite compelling. Why factor cost for measuring growth? Well, think about it. Market prices can be misleading if you're trying to see if real production increased.
How so?
Imagine the government suddenly decides to slap a huge new tax on, say, cars. The market price of cars will shoot up, right?
Yep, definitely.
Now, if you measure the total value of output using these new higher market prices, it could look like the economy grew significantly in the car sector. But what if the actual number of cars produced didn't increase at all, or even fell slightly?
I see. The growth would just be reflecting the tax hike, not any actual increase in physical production or value added by the factors.
Exactly. Measuring growth based on factor cost helps to isolate the change in the value generated by the production process itself. It reflects changes in the volume of goods produced or perhaps improvements in efficiency, independent of shifts in government tax and subsidy policies, which can distort the market price signal.
So factor cost was seen as a pure measure of underlying productive growth.
For growth analysis, yes. That's not to say market prices aren't useful. They absolutely are. They reflect the total amount consumers actually pay. They incorporate the full tax burden, which is important for understanding consumer impact, government revenue, and for making cross-country comparisons where tax structures differ widely. But for tracking the change in production itself, factor cost was often preferred.
And just theoretically, the sources mentioned, factor cost and market price would only be the same in a kind of fantasy world, right? Where there are no indirect taxes and no subsidies at all.
Or perhaps where total indirect taxes perfectly happen to equal total subsidies, netting out to zero. But yeah, that's more of an academic point. In reality, there's always a gap.
Okay. Now, there's still another layer of complexity with prices. We've talked about factor cost versus market price, but all the values we've discussed so far, whether factor cost or market price, are in monetary terms, rupees, dollars, whatever. But the value of money itself isn't constant, is it?
No, it absolutely isn't. It changes over time, primarily due to inflation.
Inflation, good old rising prices.
Exactly. If there's inflation in the economy, the general level of prices for goods and services increases over time. Now, think about what that does to our monetary value of output.
Well, if prices go up, the monetary value will go up too, right?
Mhm.
Even if we produce the exact same amount of stuff.
Precisely. That's the core issue. Let's use a simple example. Suppose last year you produced, say, 100 apples and sold them for 10 each. Your total nominal output value was 1,000.
Okay.
Now this year, suppose you produce the exact same 100 apples. No increase in physical production. But because of inflation, the price of apples has risen to E11 each.
So now the total value is 100 times euro, which is 1,100. Right.
Right. So measured in current money terms, your output value increased from 1,000 euros to 1,100. It looks like 10% growth. But did you actually produce more apples?
No, same amount. The growth was purely due to the price increase.
Exactly. So if you just look at the raw monetary figures, the nominal values, without accounting for the effect of inflation, you could get a completely misleading picture. You might mistakenly believe the economy is booming, when in reality, it's just that prices are going up rapidly.
So we need to adjust for inflation to see the real picture.
Absolutely critical. This is where we distinguish between nominal values and real values. Nominal value is the monetary value measured at the prices prevailing at that time, current prices. It includes the effect of any price changes, inflation or deflation.
Okay, nominal is current prices, includes inflation.
Real value, on the other hand, is the monetary value adjusted to remove the effect of inflation. It's calculated as if prices had remained constant. Usually, this is done by measuring everything using the prices from a specific chosen year in the past called the base year. That's why you often hear the term at constant prices.
And how do they actually make this adjustment? Do they just guess?
No, it's done using statistical tools, price indices. The most common one for overall economy adjustment is called the GDP deflator. It's a broad measure that tracks the average price change of all the goods and services included in GDP. By dividing the nominal GDP figure by the GDP deflator, scaled appropriately, you essentially strip out the price increase component, leaving you with the real GDP value.
So going back to your example, if nominal output grew by, say, 9%, but inflation during that same period was also 9%.
Then the real growth is 0. 9 minus 9 is 0. There was no actual increase in the physical quantity or volume of goods and services produced. The entire nominal increase was just eaten up by rising prices.
So this is really important. When we hear economists or news reports talking about economic growth figures, like the economy grew by 5%, they are almost by definition, talking about real growth.
Yes, that is the standard convention globally. The term growth in this economic context inherently implies that the figure has been adjusted for inflation. It represents the increase in output measured at constant prices. If they meant nominal growth, they would usually specify nominal growth or growth at current prices.
Okay, so growth means real growth. And in the Indian context, historically, the sources say growth specifically referred to the increase in, was it GDP at factor cost at constant prices?
Historically, yes, that was often the benchmark figure emphasized for growth. GDP measured at factor cost, adjusted for inflation using a base year. However, and this is a key point we'll need to unpack, the specific measure used for the headline growth number has actually changed with the recent revisions in India's methodology, even though the fundamental principle of measuring real inflation-adjusted growth remains absolutely central.
Okay. Another nuance from the recent changes, we'll definitely need to get back to that. But first, with all these layers, final goods, domestic versus national, gross versus net, factor cost versus market price, nominal versus real. Who actually does all this incredibly complex calculation in India? Who's responsible for producing these official numbers?
The main responsibility for compiling and releasing these national income aggregates, GDP, GVA, NNP, all of them in India, falls to the Central Statistical Organization, usually known as the CSO.
CSO.
Okay.
And they're part of a government ministry.
Yes, they operate under the Ministry of Statistics and Program Implementation, or MOSPI, Government of India. Think of them as the official scorekeepers for the Indian economy.
And how often do they release these scores? Is it just an annual thing?
No, they provide updates more frequently than that, which is important for policymakers and businesses trying to understand current conditions. The CSO releases quarterly estimates of GDP, GVA. These usually come out about 6 weeks or so after the end of each quarter. So after the end of March, June, September, and December.
Okay, quarterly updates, and then a big annual one.
Yes. They also compile and release comprehensive annual estimates. These cover the Indian financial year, which, importantly, runs from April 1st to March 31st. That's the standard accounting year for the government and most businesses in India.
Right, different from the calendar year, January to December, used in many other countries.
Exactly. So the annual figures align with that April-March financial year.
And the sources mentioned briefly, just as an aside for people really digging deep into economics, that the CSO doesn't just rely on one method. They actually use, or can use, 3 different approaches to calculate these numbers, right?
That's correct. We've mostly focused today on the output or production method, adding up the value added by different industries. But there's also the income method, summing up all the factor incomes: wages, rent, interest, profit generated in the economy, and the expenditure method, summing up all the spending on final goods and services, consumption, investment, government spending, net exports.
And in theory, all 3 methods should arrive at the same total GDP figure.
In perfect theory, yes. They're measuring the same economic flow from different angles. In practice, there are always statistical discrepancies due to data limitations, but they use these different approaches to cross-check and build the most robust estimate possible. It shows the complexity and the sort of internal checks and balances in the system.
Okay. Now, all this calculation, whichever method you use, relies heavily on definitions, on specific methodologies, and, crucially, on the data sources available. And none of these are set in stone forever, are they? Economies evolve.
They absolutely do, constantly. New industries pop up, old ones decline, technology completely changes how things are produced, consumer tastes shift. The whole structure of the economy is dynamic.
Which means the way we measure the economy can't stay static either. It has to be updated periodically to stay relevant.
Exactly. And that brings us squarely to the very significant recent change in India. The introduction of the revised National Accounts Series, the one with the 2017-18 base year.
This is what's called rebasing the national accounts.
Yes. Rebasing is the process of updating the base year used for calculating those constant price or real GDP figures. But it's often much more than just changing the year. It's an opportunity to overhaul the entire system.
Why is it so necessary to do this periodically?
Primarily because, as we said, the structure of the economy changes. Production patterns shift. Maybe the service sector becomes much more important than it used to be. Technology might make certain manufacturing processes way more efficient. Relative prices also change significantly over time. The price of computers might fall while the price of healthcare rises, for example.
So if your measurement system, and particularly the prices you're using for your constant price calculations, are based on the economy as it looked, say, 10 or 15 years ago,
You're essentially using an outdated map to navigate the current economic landscape. Your picture of the economy's structure and growth could become distorted.
Right. So the goal of rebasing is to make sure the national accounts reflect the current structure of the economy as accurately as possible and use more up-to-date price levels for measuring real growth.
Precisely. It achieves several things. It provides fresh, updated information on the economy's composition, which sectors are bigger or smaller now. It helps policymakers and analysts judge the actual size of the economy more accurately. It can correct biases that might have crept into the estimates due to using outdated methodologies or data sources. And it gives a clearer picture of the relative importance of different sectors based on a more contemporary snapshot.
And this latest revision in India, it shifted the base year for constant price calculations from 2011-12 forward to 2017-18.
Yes. But, crucially, the sources emphasize this wasn't just a simple update of the base year. The 2017-18 series incorporated some really significant improvements and changes compared to the previous 2011-12 series.
Like what kind of improvements?
Things like more comprehensive coverage of certain sectors, particularly the corporate sector, and government activities were expanded. They incorporated findings from more recent and more detailed national sample surveys, NSS, to get a better handle on the informal economy. And, very importantly, there were substantial changes in the actual evaluation methods, the statistical approaches used, the underlying concepts, and even the classification systems for industries.
Wow. Okay, so this sounds like a pretty fundamental overhaul, not just, tweaking a few numbers. It's like they rebuilt parts of the measurement engine.
That's a good way to put it. It was a significant modernization effort. And, as often happens with such major changes, these shifts in definitions, data sources, and calculations led to some, well, confusion and considerable debate, particularly around how specific sectors appeared to be performing under the new lens compared to the old one.
Right. You mentioned manufacturing earlier, so understanding the specific changes in terminology and calculation that came with this new series is absolutely vital, isn't it? Because the words themselves changed, and that affects how we interpret the headline numbers we see now.
It's absolutely crucial. If you don't understand the change in terminology, you could easily misinterpret the data.
Okay, let's break down the terminology shift first. Under the old system, the 2011-12 base, what was generally called GDP at factor cost, was often the main number people focused on for growth analysis, right? Sometimes just called GDP.
Yes, that was common practice.
Yeah.
GDP growth often implicitly meant growth in GDP at factor cost at constant prices. This measure, as we discussed, represented the sum of the factor incomes, wages, rent, interest, profit generated in the economy.
And it was reported both at current prices, nominal, and constant prices, real, using the 2011-12 base. And there was also a separate figure called GDP at market prices, which you got by adding net indirect taxes to that factor cost number.
Correct. That was the old structure. Now, the new system, the 2017-18 base, changes the main terms quite significantly, aligning more closely with international standards like the System of National Accounts, SNA.
Okay, so what are the new key terms?
Firstly, the detailed industry-wise breakdown of economic activity, the value added by agriculture, manufacturing, services, etc., is now presented as gross value added, GVA, at basic prices.
GVA at basic prices. Okay. Not GDP at factor cost anymore for the sectors.
Right. GVA at basic prices is the new term for the sectoral value added measure. And secondly, the figure that was previously known as GDP at market prices is now referred to simply as GDP.
Whoa, okay, hold on. That's a big change. So the headline GDP number we hear quoted all the time now under the new system is actually what used to be called GDP at market prices.
Exactly. When you see the main aggregate GDP figure reported today under the 2017-18 series, it represents the total value of output measured at market prices, inclusive of product taxes, net of product subsidies.
And the detailed sectoral data, like for manufacturing or services, is now GVA at basic prices. So when you see a headline saying GDP grew by X%, it's technically referring to growth in the market value of total output, not the factor cost value, which was often the focus before.
That is correct. The headline GDP growth number now reflects growth at market prices. Now, GVA at basic prices, you can think of that as representing the value added by producers, measured before those product-specific taxes, like GST or sales tax, are added, but after accounting for production taxes, like property taxes, and subsidies related to the production activity itself. It's sort of like a producer price concept, sitting between factor cost and market price.
Okay, so GVA at basic prices is the value from the producer's gate, roughly. And the new GDP at market prices is what the final buyer pays, including all the net product taxes.
That's a good way to conceptualize it. And the new formula for calculating this headline GDP makes this relationship explicit. The source is stated as GDP in Shire GVA at basic prices plus product taxes, product subsidies.
Right. GDP equals the sum of all the sectoral GVAs at basic prices plus the net taxes specifically levied on products.
Precisely. And this formula highlights another really critical distinction that was introduced or made much more explicit in the new series: the clear separation of production taxes and subsidies from product taxes and subsidies.
Okay, you mentioned this briefly before. This distinction wasn't as clearly separated under the old net indirect tax concept.
It wasn't treated in exactly the same way in the calculation framework. The new system makes this distinction very clear, and it affects how GVA and GDP are calculated.
So can you remind us of the conceptual difference again? Production taxes subsidies versus product taxes subsidies.
Sure. Production taxes and subsidies are those that are related to the activity of production itself, and they're often payable regardless of the actual volume or value of output produced and sold. The sources give examples of production taxes like land revenues, stamp duties, registration fees paid by businesses, or taxes on professions. These are costs incurred just for being in business or undertaking production.
Okay, taxes on the activity and production subsidies.
Production subsidies are payments received by producers that support the production activity itself, again, often not directly linked to the number of units sold. Examples given include subsidies paid to railways to cover operational costs, input subsidies given to farmers, like for seeds, electricity, or irrigation, which lower their production costs, subsidies to village and small industries to encourage their activity, or administrative subsidies paid to certain corporations or cooperatives.
Got it. Support for the production process, and then product taxes and subsidies are directly linked to the goods or services themselves.
Exactly. They are levied or granted per unit of the good or service produced, sold, imported, or exported. Product taxes include things like excise duties, historically, sales tax, value-added tax, VAT goods and services tax, GST, service tax, and import-export duties. They're directly tied to the transaction or the unit value.
Right, taxes on the product itself, and product subsidies.
Product subsidies are payments made per unit of a good or service, usually to reduce the price paid by the final consumer. Classic examples include food subsidies, making staples cheaper, petroleum subsidies, like on LPG or kerosene, fertilizer subsidies, reducing costs for farmers per bag, or interest subsidies routed via banks to specific borrowers, effectively lowering the price of credit for certain transactions.
Okay, that distinction is much clearer now. Production taxes subsidies relate to the activity. Product taxes subsidies relate to the unit. And how does this affect the new calculations?
So in the old system, all these taxes and subsidies were essentially bundled together into net indirect taxes, which were added to GDP at factor cost at the very end to get GDP at market price. In the new system, it's a two-step process. Net production taxes, which are production taxes minus production subsidies, are considered part of the cost structure within the calculation of GVA at basic prices for each sector.
So net production taxes are now embedded within the GVA figure itself.
Yes. GVA at basic prices equals GVA at factor cost, old concept approximately, plus net production taxes. Then, to get to the final headline GDP at market prices, you take the sum of all the sectoral GVAs at basic prices, and then you add the net product taxes minus product subsidies.
Okay, so GVA basic, factor cost plus net production taxes.
Okay.
Then GDP market equals sum of GVA plus net product taxes.
That's the conceptual flow, yes.
Right.
And the sources explain that this methodological change has a direct impact. It affects the reported size of GVA for different sectors compared to what their old GDP at factor cost figures would have been.
How so?
Well, take a sector like manufacturing. It typically has significant positive net production taxes. Things like factory licenses, property taxes might outweigh any production subsidies it receives. Because these are now included in GVA at basic prices, the reported GVA for manufacturing will tend to be higher than its old GDP at factor cost equivalent would have been.
Right. Whereas a sector like agriculture might receive significant production subsidies, like input subsidies, which could make its net production tax figure low or even negative, meaning its GVA at basic prices might be closer to or even lower than its old factor cost equivalent.
Precisely. So the relative size of sectors can appear slightly different, and maybe even more importantly for tracking trends, Changes in these production taxes and subsidies over time can now directly influence the reported growth rate of a sector's GVA.
Which wasn't the case before.
Not in the same way. The old GDP at factor cost measure was specifically designed to be insulated from changes in indirect taxes and subsidies. Now, changes in production taxes subsidies can feed directly into GVA growth rates. Changes in product taxes subsidies will affect the growth rate of the overall GDP at market prices, but not the GVA growth rates.
Wow. Okay, this technical shift in how different types of taxes and subsidies are accounted for, it really starts to explain why the numbers for certain sectors might have looked quite different under the new series and why it might have sparked some debate.
It's a key part of the explanation, yes.
You mentioned the manufacturing sector specifically earlier. The sources highlight this, right? There was a perception, maybe based on other indicators, that manufacturing output was struggling, maybe even falling in some periods. But the new GVA figures often painted a much more optimistic picture, showing better performance.
Yes, that was definitely a major point of discussion and sometimes contention when the new series was introduced and subsequently updated. People looked at, say, industrial production index figures, which might have seemed weak, and then saw GVA growth for manufacturing looking relatively robust and questioned the discrepancy.
So what was the explanation offered in the sources for this? Was it just the tax accounting change?
The tax accounting plays a role in the level, as we discussed. But for the performance or growth rates, the core explanation offered is twofold. First, a reminder that GDP and GVA measure value added, not just physical output quantity. And second, several major changes in data sources and methodology significantly improved the measurement of value added, particularly in manufacturing.
Right. Value added versus quantity. So a company could be producing roughly the same number of widgets, but if they become much more efficient in their process, or maybe they've invested heavily in branding and marketing, which increases the final price they can command relative to their input costs.
Or if they've shifted to producing higher value types of widgets, their value added, GVA, can increase significantly, even if the simple quantity of widgets hasn't changed much or even fallen slightly. The new series was argued to be better at capturing this value addition aspect.
Okay. And what were the specific reasons, the changes in data and methods, that allowed the new series to capture this value addition better, according to the sources? This is where we really see how the measurement details matter.
Absolutely. The sources detail several key reasons, particularly for manufacturing.
Okay, reason number one.
A major shift was moving from primarily an establishment-based approach to an enterprise-based approach, especially for the formal corporate sector.
Establishment versus enterprise. What's the difference there?
In the old system, using data mainly from sources like the Annual Survey of Industries, ASI, the focus was often very narrow. It looked at the establishment, meaning a specific factory or plant location, and tried to measure just the manufacturing activity happening within that physical unit.
Okay. Just the factory floor, basically.
Largely, yes. The new system adopts more of an enterprise approach. It tries to account for the entire company or enterprise involved in manufacturing. This includes not just the factory floor activities, but also all the related ancillary activities that contribute to the final value of the manufactured product. Things like the company's R&D, logistics operations, marketing and sales efforts, brand building, software development related to the product, head office administrative functions.
Yeah.
All of these things add value.
Ah, so it's capturing a much broader slice of the economic activity that's actually tied to producing and selling that manufactured good, not just the physical assembly.
Exactly. It aims for a more holistic view of the value created by manufacturing companies. And where did the data for this broader enterprise-level view come from? This was a huge change.
Right. This was the MCA 21 database.
Yes. A key methodological shift was the large-scale incorporation of data from the Ministry of Corporate Affairs MCA 21 database. This is an e-governance initiative that collects financial statements and other information from all companies registered under the Companies Act in India.
And that's a lot of companies, right?
A massive number compared to previous surveys. The sources mentioned it covers around 500,000 active companies. This provides a much, much larger and arguably more representative dataset for the formal registered corporate sector than the smaller sample-based surveys primarily used before, like certain RBI studies or even the ASI, which covered only the factory segment.
So vastly improved coverage and detail for the organized manufacturing sector, capturing more of their total value chain. That's reason one. What was the second reason for the change in manufacturing figures?
The second reason relates to the other part of manufacturing, the unorganized or informal sector. The new series incorporated updated and more comprehensive data from important large-scale household and enterprise surveys conducted by the National Sample Survey Office, NSSO. Specifically mentioned are the findings from the Unincorporated Enterprises Survey done in 2010-11 and the Employment and Unemployed Survey from 2011-12.
So better data sources weren't just for the big companies, but also for the millions of smaller, unregistered manufacturing units.
Exactly. These surveys provide crucial information on the size, structure, and performance of the vast informal economy, including unorganized manufacturing. Integrating this more recent survey data improved the representation and accuracy of this segment within the overall GVA calculation. So you have better data for both the organized and the unorganized parts of manufacturing contributing to the new estimate.
Okay, better data overall was the third reason mentioned.
The third reason is a change in how labor input was measured, particularly for the unincorporated, informal manufacturing and services sectors.
How did that change?
The old method often simply assigned equal weight to all types of workers when calculating value added based on labor input. You count the number of workers, essentially. The new method introduced what's called the effective labor input method. This attempts to be more sophisticated by assigning different weights to different categories of workers based on estimates of their relative productivity.
Ah, okay. So it tries to account for the fact that, say, an hour worked by a highly skilled technician might contribute more value added than an hour worked by an unskilled helper.
That's the underlying idea, yes.
Yeah.
By weighting labor input based on productivity differences, it aims to get a more accurate measure of the contribution of labor to value added in these typically harder to measure informal sectors.
Makes sense. And the fourth reason, did that circle back to the taxes?
Yes, the fourth reason highlighted is the inclusion of those net production taxes minus production subsidies, within the GVA at basic prices calculation. As we noted before, net production taxes are generally positive in the manufacturing sector.
Right. Things like property taxes on factories, registration fees, etc., usually outweigh direct production subsidies.
So including this positive net tax figure directly into the GVA calculation mechanically increases the reported size or level of GVA for manufacturing compared to what its old GDP at factor cost figure would have been, and potentially affects its share relative to other sectors where net production taxes might be lower or even negative, like agriculture or electricity, which often receive significant production subsidies. This contributes to manufacturing appearing relatively larger in the new series framework.
Okay. So putting it all together, the picture of manufacturing performance looked different in the new series. Not necessarily because the physical reality on the ground changed exactly in line with the numbers overnight, but significantly because the way it was being measured changed quite fundamentally.
That seems to be the main point the sources convey. It was a combination of 1. Moving to an enterprise view, capturing more value-added activities beyond the factory floor. 2. Using much broader and more comprehensive data sources for the formal sector, MCA 21. 3. Incorporating better, more recent survey data for the informal sector, NSSO. 4. Using a more refined method to measure labor input based on productivity. 5. And changing the accounting treatment of production-related taxes and subsidies.
It really underscores how much the choice of data sources and methodology matters. It wasn't just a minor tweak. It was a shift to a different, hopefully more accurate, but definitely different way of looking at the sector's contribution.
Exactly. The shift to these newer, broader data sources like MCA 21 is emphasized as a major driver of the differences observed, perhaps even more so than just the methodological updates themselves.
And it's probably worth noting, as the sources do, that even these new GDP-GVA numbers aren't absolutely final and fixed for all time. They can still be subject to revisions, right?
Oh yes. National accounts are always subject to revisions as more complete data becomes available. But even beyond routine revisions, the sources mention a specific potential source of future changes. Updates to the base years of the key price indices that are used in the calculations.
Which price indices are those?
Things like the Index of Industrial Production, IIP, the Wholesale Price Index, WPI, and the Consumer Price Index, CPI. These indices are crucial inputs. They're used, for example, as deflators to convert nominal values, current prices, into real values, constant prices, or sometimes to extrapolate production volumes.
So if the government decides to update the base year for, say, the WPI or the CPI,
That requires a recalculation of the constant price GDP and GVA series using the price relationships from that new base year. This can lead to revisions in the previously reported real growth rates for past years and the present. It just shows that national accounting is an ongoing process of estimation and refinement, constantly trying to keep up with the changing economy and improving data availability.
wow, we have really, really gone deep today. It's quite a journey, isn't it?
It really is. There's a lot under the hood of that single GDP number.
We started right at the beginning, didn't we? The fundamental concept of economic output, just the value of final goods and services, and why we have to be so incredibly careful to avoid that trap of double counting intermediate goods.
Yeah, the final goods rule. And then we looked at who actually does the producing: individuals, companies, government, foreign firms operating domestically, and the factors they use: land, labor, capital, entrepreneurship.
And that beautiful link between the cost of using those factors and the income they generate. Cost equals income equals output, three sides of the same coin.
Then we navigated the borders, the difference between domestic production inside the country and national income accruing to residents, and why GDP, the domestic measure, became the global headline figure, partly due to issues with measuring NFIA accurately and its volatility.
Right. And then accounting for wear and tear depreciation. Moving from gross concepts like GDP and GNP to net concepts like NDP and NNP.
And the pricing puzzle: factor cost versus market price, and the role of indirect taxes and subsidies in creating that gap. Plus, the absolute necessity of adjusting for inflation to get real growth, distinguishing it from purely nominal increases.
We saw who does the math in India, the CSO, and how often they report, quarterly and annually for the financial year. And then we spent a good chunk of time delving into those really significant recent revisions to India's national accounts.
Yeah, the shift from the 2011-12 base to 2017-18, understanding the crucial terminology, change GDP at factor cost, giving way to GVA at basic prices for sectors, and the old GDP at market prices, now just being called GDP.
And the key distinction between production taxes subsidies, affecting GVA basic, and product taxes subsidies, affecting the final GDP market price.
And finally, unpacking the detailed reasons, especially the major improvements in data sources like NCA 21 and NSSO surveys, the enterprise approach, and methodological refinements that led to a different, potentially more accurate, but certainly different picture for key sectors like manufacturing under the new series.
It just really hammers home the point, doesn't it? That single number you see reported as GDP growth, it's really just the tip of a massive, intricate iceberg. An iceberg made of definitions, data collection efforts, complex statistical methodologies, adjustments, and underlying assumptions.
Absolutely. And hopefully understanding these underlying components gives you, the listener, a much richer perspective. You can appreciate what those numbers actually represent, why they might sometimes be debated or revised, and what limitations they might have.
Yeah. It's not just about accepting the number unquestioningly. Knowing how it's constructed helps you become a more informed, more critical consumer of economic news. When you hear a growth figure now, you understand, okay, that's real growth, inflation adjusted, based on final goods and services produced within the country's borders, GDP, calculated using specific evolving methodologies that rely on particular data sources. And under the current Indian system, it's reported at market prices.
It's not just some magical number plucked from the air. It's a complex measurement with specific rules and inputs.
And, thinking about all this measurement complexity, it prompts a really interesting question that goes a bit beyond the mechanics we've discussed. The sources very briefly mentioned another concept entirely. The Gross Happiness Index, or GHI, pioneered in Bhutan.
Ah, yes, GHI. A very different perspective.
Right. Introduced way back in 1972. And its whole philosophy is that the sustainable development needs a more holistic approach. It argues we need to give equal importance to the non-economic aspects of well-being alongside the traditional socioeconomic factors we usually focus on, like health, education, living standards.
So it tries to measure things that GDP explicitly doesn't capture. Things like cultural preservation, psychological well-being, good governance, community vitality, ecological diversity.
Exactly. It serves as this really potent reminder, I think. While GDP is undoubtedly a powerful and essential tool for measuring the scale and changes in market-based economic activity, the size of the economic pie, if you like.
It doesn't, and was never designed to, measure everything we might care about. It doesn't inherently measure well-being or happiness or the fairness of distribution, equity or environmental sustainability.
Which leads us to a final thought for you, our listeners, to perhaps ponder after this deep dive into the nuts and bolts of economic measurement. Given that the very methods we choose to measure our economy significantly shape our perception of progress, how does knowing all these intricate details behind a number like GDP, knowing its specific definitions, its limitations, its reliance on particular data streams and calculation methods, how does that change the way you interpret the headlines about economic growth?
And maybe more broadly, how does the very existence of alternative frameworks like the Gross Happiness Index challenge our fundamental understanding of what a truly successful country or a genuinely thriving society looks like? Is maximizing GDP the only goal or just one part of a much bigger picture?
Definitely something to keep in mind the next time you see those big economic figures flashing across your screen.
Food for thought.
That's been our deep dive today into understanding the output of an economy. We hope you feel a little more equipped now to understand what those often quoted numbers really represent.